Hello and welcome to Module 4 of the Technical Analysis Masterclass, Trading Indicators. In this section, we will look at how to use and interpret the Relative Strength Index. More commonly known as the RSI indicator, we will look at the different ways that you can use this momentum indicator, as well as identifying the market conditions that the RSI works best in. In this lesson, you will learn how to establish a trend bias using RSI. You'll learn how to trade RSI in the direction of the trend. You'll learn how to identify and trade RSI failure swings. And finally, you'll learn how to interpret and trade RSI divergence. The Relative Strength Index, more commonly known as the RSI indicator, is a momentum indicator that measures the speed and change of price movements. The indicator is made up of one line called the RSI level, which, like the stochastic oscillator, operates in a band between 0 and 100. Not to be confused with traditional relative strength, where one instrument is measured against another, the RSI measures the average gain over a set period versus the average loss of the same period on the same instrument. The RSI indicator is most commonly traded using overbought and oversold zones, but we will also look at how you can interpret and use this powerful indicator in different market conditions. Let's look at how the RSI is calculated, which will help you understand how and why the indicator works best in particular markets. The RSI indicator is made up of one line, the RSI level, which involves a two-step process to generate the value. The first step is to calculate the relative strength value. This is worked out by taking the average gain of positive periods for a set time frame and dividing it by the average loss of negative periods for a set time frame. Calculating the average gain is done by multiplying the previous average gain by 13 and adding that to the current average gain and dividing it by 14. The current average gain is the sum of gains over the prior 14 periods divided by 14. Calculating the average loss is done by multiplying the previous average loss by 13 and adding that to the current average loss and dividing it by 14. The current average loss is the sum of the losses over the prior 14 periods divided by 14. Now that you have the RS value, the second part of the calculation can be worked out, which gives you the RSI level. The calculation for the RSI level is 100 minus 100 divided by 1 plus the relative strength calculation. This formula normalizes the relative strength and turns it into a range-bound oscillator that fluctuates between 0 and 100, making it easier to recognize extreme levels. Now, although it may seem a little complicated, the reality is that you will never have to work it out manually, as most platforms have the RSI indicator as standard, and it adapts itself to each time frame you put it on, using the last 14 periods to plot its level. However, understanding how the RSI is derived is important in the context of adapting it to the market you're looking at. For example, the RSI at the 100 level tells you that the price was higher for all the prior 14 periods, and if the RSI level is at 0, there are no gains for the prior 14 periods, meaning price must have been lower or unchanged for the entire time, as there is no gains to measure. Let's now look at RSI to establish a trend bias. For this method, you firstly identify a trend. In this case, you can see on the chart on the screen that on the left there is a downtrend in place, with a series of lower peaks and lower troughs. You can see that the RSI indicator remains under the 50 level for the entirety. To trade this method, you simply place a trade in the direction of the trend each time the RSI rises from its lows and comes up to touch the 50 level. You can see at the beginning and in the middle of the chart that a downtrend is in place, and each time the RSI came up to touch the 50 level, it gave another opportunity to join in the downtrend. The opposite is true for a long trend. When you identify an uptrend for a series of higher peaks and higher troughs, you simply place a trade in the direction each time the RSI pulls back down from its highs and touches the 50 level. Although this method is a reasonable approach, all the RSI indicator is really doing is confirming what you probably already know, that the market is in an uptrend or a downtrend. It does, however, signal good pullback opportunities to join in the direction of the trend, as often the market pulls back right to the 50 level at the deepest point of its retracements. Let's now look at trading RSI in a trend. A more robust method of using the RSI in a trend is waiting for the RSI to cross the 50 level during a trend and then crossing back in the trend's direction. You can see in the chart on the screen that there is a series of lower peaks and lower troughs confirming a downtrend. The RSI then crosses above the 50 level, only to come back down not long after. The trade can be placed in the direction of the trend once the RSI closes below the 50 level. On the right of the chart, you can see that there is an uptrend in motion, with a series of higher peaks and higher troughs. Once the uptrend is confirmed, the RSI crossed below the 50 level, only to cross back up shortly after. The trade can be placed in the direction of the trend once the RSI closes above the 50 level. This method, although simple, is a reliable way to use the RSI indicator, as a cross of the 50 level in either direction, followed by a cross back in the direction of the trend, confirms that the buyers in an uptrend and the sellers in a downtrend have committed to the trend's direction over the last 14 periods. The next method explains how to use overbought and oversold levels when trading in the direction of the trend using RSI. This method involves changing some of the settings on the levels to provide optimal retracement zones. Traditionally, the 30 level on the RSI indicator is considered an oversold level, but in a healthy uptrend, the market rarely pulls back to this level, and if it does, the strength of the trend could be questionable. To trade this method in an uptrend, you simply raise the oversold level from 30 to 40. Although this makes the oversold level larger, it gives the market an opportunity to pull back to a solid level without losing too much momentum. Once the chart has been adjusted, you will be on the lookout for an uptrend, with a series of higher peaks and higher troughs. Once the uptrend is confirmed, you wait for the RSI line to drop and close below the new oversold level of 40. When the RSI line crosses back above this level, you have a signal to take a long position in the direction of the trend. The two vertical lines that we can see on the chart on the screen represent where this happened, and although the entry points are only just crossing into the oversold zone, it helps illustrate why the level needs to be raised, as not to slow up too much upward momentum. Trading this method short again involves changing some of the settings on the levels to provide optimal retracement zones. Traditionally, the 70 level on an RSI indicator is considered an overbought level, but in a healthy downtrend, the market rarely pulls back to this level, and if it does, the strength of the trend is in serious doubt. To trade this method in a downtrend, you lower the overbought level from 70 to 60. Again, even though this makes the overbought level larger, it gives the market an opportunity to pull back to a solid level without losing too much momentum. Once the chart is prepared, you'll be on the lookout for a downtrend, with a series of lower peaks and lower troughs. Once the downtrend is confirmed, you wait for the RSI line to rise and close above the new overbought level of 60. When the RSI line crosses back below this level, you have a signal to take a short position in the direction of the trend. The two vertical lines that we can see on the chart on the screen represent where this happened, and again, although the entry points are only just crossing into the overbought zone, it helps illustrate why the level needs to be lowered, as not to slow up too much downward momentum. Note that in both examples, the same chart was used to highlight how often these signals can occur. Let's now look at RSI failure swings. Failure swings are unique to RSI in that they are recognized as strong indicators of possible reversal signals without factoring in price action. The actions of the signal line are the focus of failure swings, not price action, and often provide reliable signals when they form. For this method, although you can use default settings, you may want to adjust the oversold and overbought levels to 40 and 60 respectively to help maintain market momentum. A bearish failure swing forms when the RSI line moves above the overbought line, drops back through it, only to retreat to around the same level, before making a new low. You can see in the example on the screen, highlighted by the blue box, that price has sold off aggressively once this failure swing was confirmed. You can take a short position on the open of the next candle, once the failure swing has confirmed a new low. A bullish failure swing works in much the same manner, and forms when the RSI line closes below the oversold level of 40, retraces back to close above the 40 level, only to come back again to the 40 level. The RSI line then holds above this level, and goes on to make a higher high, as we can see in the example in the blue box on the right. You can take a long position on the open of the next candle, once the failure swing has confirmed a new high. Let's now look at trading RSI divergence. Divergence occurs on the RSI indicator in much the same way it does with the MACD and stochastic oscillator, and you can apply the same rules on how to trade it. The example that we can see on the screen displays a situation where price has made a lower low, and the RSI indicator has failed to follow, making a higher low at around the same area. You will recall that this is considered Class A bullish divergence. Over in the middle of the chart, you can see that price has made a new higher peak, and the RSI indicator has failed to follow, making a lower peak at around the same area. This can be labelled as Class A bearish divergence. And finally, on the right of the chart, you can see that price has made a lower trough, and the RSI indicator has failed to follow, making an equal trough at around the same area. This can be labelled Class C bullish divergence. Much like the stochastic oscillator, the key to using the best divergence signals on the RSI indicator is only trading the divergence where the first peak is in the overbought zone for bearish divergence, or the first trough is in the oversold zone for bullish divergence. Following this rule highlights the extremes that the RSI indicator has reached, which strengthens the case when the divergence signal appears. In this lesson, we've learned how to establish a trend bias using RSI. We looked at how to trade RSI in the direction of the trend. We learned how to identify and trade RSI failure swings. And finally, we learned how to interpret and trade RSI divergence. This concludes section 4 of trading indicators. In the next section, I will explain how to interpret and use the Bollinger Bands indicator, one of the best market volatility indicators available to traders.